Our main focus point is about gold and a simple guide to investing in gold. Now, I've said at the top of the show, this may not be the best short-term time to buy gold. It's ran a lot, and it was just on the cover of Barron's. But there are a lot of longer, medium and long-term tailwinds to the price of gold. We see geopolitical uncertainty, and I'll get to that in a second. But there are a lot of reasons to be bullish gold, like I said, medium and long term. But let's get into the pros and cons of investing in gold in general and see if it's right for you to, maybe pick up some if you don't have any, or add to your position on any short-term weakness. Now, the pros of investing in gold are it's a tangible asset, can't be debased, and it doesn't have a direct connection to the performance of the stock market, for better or for worse. That can be a good thing. It can be a bad thing. Depends on what's happening in the broader market, right? So it is a hedge against inflation. And more accurately, it's a hedge against monetary debasement. I've talked before. I think I quoted that gold was up 8 times since 2000. I think it's actually up 10 times. And that was a couple months ago when I looked at that number. So it's probably up even more. And it pretty much correlates with the amount of the growth in U.S. debt over from 2000 until today. So if you think that the U.S. government is going to continue its financial largesse and grow the amount of debt outstanding, then gold is going to naturally likely follow that number. Now, it is a hedge, like I said, a hedge against inflation, hedge against monetary debasement, and it also acts as a diversifier for a portfolio, typically moving in the opposite direction of the stock market. This year's a good example, right? Markets down considerably, gold up considerably. Doesn't always move that way. Sometimes they move in the same direction, but generally it tends to be a good portfolio hedge. For example, 2008. You had the financial crisis. It was around 400 to 600 in that range, 2008. And then by 3 years later, it was at $1,000 an ounce. And a lot of that had to do, once again, with us printing money and running large deficits, et cetera. And we continue to do so to this day. It's also a safe haven asset. So in 2016 Brexit, for example, it was up 10% in 1 month. It tends to go up in more uncertain social and geopolitical uncertain times. And obviously now is one of those. And then it's physically durable. It can't be destroyed in a disaster. It can't be worn down over time. It's been there for thousands of years and will be here thousands of years beyond you and I on this earth. Now, what are the cons? It's expensive to hold, right? You can get it stolen if you have it in your home, for example. And if you want someone else to store it for you, you're going to have to pay. It also can be illiquid. If you want to pay for something, it's not the easiest to cash out, physical gold. And it doesn't pay some sort of a dividend. Now, what are the ways you can invest in gold? First would be physical bullion or ingots. And ingots are pressed, gold bars are poured. And then there's coins. So those are another way. You lose your little premium for the coins. But that's physical form. And gold for investment, usually 99.5% pure. So there are different purities, right? 14 karat, et cetera. But, for investment, you want those 99.5% plus pure. Then you can buy funds, ETFs, mutual funds, and they tend to be much more liquid, right? If you want to cash those out, you can go do that. If you want to buy something that's directly related to gold price, you can do that. GLD, right? IAU, for example. Or you can go buy mining stocks. Mining stocks are going to be more volatile and there's more upside, but there can be more challenges with the quality of the mines. You can have mine disasters. You can have mines that they're putting in operation that don't really fulfill their promise. You could have them exploring mines that don't really go anywhere and just sink a lot of expenses into, and there's not a lot out of it. So, that's the issue with mining stocks. So you have to do kind of your research. There's about 300 different mining stocks. You can buy those once again individually, or you can buy a broad-based GDX ETF, something like that. It really comes down to your risk tolerance level. If you're a high risk person, individual mining stocks, maybe using options or futures, you can do that as well. And that would be the most aggressive. So it just matters what type of investor you are. We like for our clients, we like individual mining stocks, We can do research. A lot of them pay dividends. We like that. Whereas if you own a GLD, you own physical gold, you don't get those dividends. And usually if gold prices are going up, those incremental dollars go straight to the bottom line of the miners if they're well run. And that's the biggest issue. Of those 300, there's really only a couple dozen that are really well run. The rest are either exploration companies that are just big money pits. Others are, just poorly run. And so you have to be very selective if you want to find the best, but you can find them just like we do for our clients. So that's the breakdown of how to think about investing in gold. Maybe not the perfect time to buy right now, but it could be worse as well, because I do think we're bullish long term.